Hello, everyone, and welcome to today's webinar, part 2 of our How to Sell Non-QM. So throughout the webinar, if questions arise to you, we want to make this as fun and as engaging for you as possible. So as questions come up, use the little questions tab and go ahead and ask it, and I will ask the question for you on your behalf to the speakers. With that, I want to turn it over to today's speakers. Let's see. And oh, sorry, Jim, I forgot to change your contact info on here, but I'm going to turn it over to Jim Voisard. And Janice, I'm going to give you clicker control.
Sure.
Take it away,
Okay,
Jim.
Rose, hello, everybody. Thank you, Rose. That title under my name is not exactly correct. Joe Leiden's the co-founder. I was involved in it, but I'm not the co-founder. So anyway, Jim Voisard with LendSure since we opened in 2015.
Awesome. Janice?
Hi, I'm Janice Chernitsky, and I'm an account executive here at LendSure Mortgage. Been here about 4 years and been top producing ever since. Hit the ground running and here to help you close more loans.
Awesome. Tanner?
Yeah, Tanner Williams, also an account executive. May remember Janice and I from last week, and Rose as well. Yeah, also here to just close loans and help people as much as we can.
Awesome. Go ahead, Tanner.
Today's agenda.
Yeah.
Is that Tanner or Jim? Tanner, go ahead.
He was going to take it, but I can take it. So similar to last week, we're going to go over some of the programs that we offer here. These ones are a little bit more unique, a little bit more niche, more specific to us. So we'll look at bridge loans, we'll look at condo hotels, also called condotels, and our fix and flip program, which we got a lot of questions on last week. So really excited to talk about that. It's very good that we have Jim Voisard on this call because he is the man in charge of that program essentially. So you'll be dealing a lot with him if you bring those loans in. Again, we'll talk about the different market opportunities, how to find leads, how to get referrals, talking points for each of these programs, conversation starters, and we'll give you links and access to marketing materials that you can utilize to go and generate this business. So a little bit about us again, founded in 2015, but realistically been doing non-QM for a long time. Our entire management team was management at Accredited back in the pre-2008 days. We're headquartered in San Diego, but we do have offices all over the country. We're securitizing our loans since 2017. Our management team is phenomenal. You guys got to listen to Joe, our co-founder, on the last call, and Jim Voisard on this call will also share his wealth of knowledge and experience. So we really lean on them. We appreciate them. And we're lending in 47 states and growing. So I know North Dakota is one we're actually working on. New York, we're very close. We have been for years, I feel like, on getting our own rocks. So yeah, very close to being in all the states.
About us, I want to say one thing and brag. This will be the only time today I'm going to brag. Those loans that Tanner mentioned we securitize and other loans have not yet been securitized. The payment record on our loans the last 7 years, our loan performance, this is a Joe Leiden line, second to none. We talked to the people in New York. Our loans, 7-year history, billions of dollars, least delinquency in all of the non-QM lenders, a number that we're very proud of. We write good loans, which makes all of us happy, including your customers.
Yeah, common sense loans. We really lean more towards, do we think this borrower is going to perform, than we lean towards, oh, well, it technically meets the guideline or it technically doesn't, right? So a little bit about what we do, what non-QM is. We're right there on the edges of conforming. We're talking about very strong, very qualified borrowers that are just barely missing the mark for Fannie Freddie, or even in some cases could qualify Fannie Freddie and choose to come to us anyway. So, of the securitizations Jim was talking about, we have an average FICO that's over 700, an average LTV between 70, 75. So we're talking about very strong, very qualified borrowers. Most cases, we're looking at ATR differently. We're getting creative on the income piece of things. We talked about bank statements, a little bit about asset depletion on our last call. I would encourage you guys to check out that recording if you missed it. We do different types of loans, different types of programs, such as a 1040 fixed interest only, the bridge loan that we're going to talk about today, the fix and flip loan that we'll talk about today. Those are more niche products, not really your standard 30-year fix that you think of. Property types, so 5 to 8 units with DSCR, we talked about that last week. Non-mortgage condos and condotels we'll hit on today, and then expanded loan amounts with our jumbos on both non-QM and jumbo prime.
Janice?
I think, yes. So sorry, my audio is a little bit funky, but so really, this is about the opportunity. This is about the
all three of them
opportunity to
froze.
get more
Do
business.
you hear me talking?
Yes, I
Don't hear
do.
me?
Jim?
It froze.
Hi, Jim. We can still hear you. You're fine. Your video just froze. Don't worry about it.
Hello, you hear me?
Jim, yes, we can hear
All right. So
you. Sorry, Janice, please
Okay.
continue.
I think we're having a
you
little technical difficulty.
Janice, go right ahead.
Okay. All right. Going back to the growth of non-QM, it's opportunity. That's really what we're here to tell you is there's a huge untapped market for you. If you've only been doing conventional loans or maybe just dipping your feet in the non-QM space, this is what we're here to teach you. What programs are out there, what niche products are going to help you tap into this non-QM volume, right? In 2021, it was 28.6 billion and growing every year, right? There really is so many things that you can do that aren't Fannie Freddie. And it really is this space where you're going to invite borrowers that might have been rejected to tell them, look, I have a home for you, a loan, right? Every loan has a home that you're going to end up being their hero. And that's going to be repeat business for you, right? If you turn down someone because their tax returns didn't work, maybe they're self-employed, right? We talked about that last week with bank statements. This week, I'm going to tell you how to help somebody who's contingent to sell before buying, and we can remove that contingency, and now you help them get the house of their dreams. So there's a lot of growth in there, and we're looking forward to teaching you about how to get into that market right now.
Absolutely.
Okay.
Bridge loan.
Yep. Transitioning wonderfully into our bridge loan, Tanner and I were going to be talking about this. Honestly, this is my favorite program, and it's my favorite program for a good reason. The housing market, the homes aren't, selling as quickly as they were, but people are still needing to buy. Could be a move-up buyer or move down buyer. I've done both kinds of bridge loans. I've done investment bridge loans. Mainly, it's going to be primary purchase, but the solution really helps them buy the house before they sell, and that's with our bridge loan. So really, it's two loans. Okay, this works exactly like a cash out refi on the departing residence and a purchase loan on the purchase, and we do both, and we fund them at the same time. It's really simple yet complex in nature, where if your borrower has enough equity in their property, and we'll go over a little bit of the guidelines, but if they have enough equity in their departing home, they can pull cash out. They'll have 0 payments due on the purchase. So for 1 year, they have a whole year to sell that house. So that equity can be easily accessed. They have the down payment, no payments due, and it really is an amazing solution. And for me, I think it's an opportunity for you to call your realtor partners or the people that you've been trying to make your realtor partners and say, hey, every for sale sign, and that's our next slide, but I get so excited, is a possible bridge loan. And you call them up and say, I can help your contingent borrowers. I can help them. And that's what we're here to do, is get you guys to help them get a loan. And then they get their dream house, right? Sometimes Jim always jokes around, but it's the, honey, pull the car over. This is the house. I have to have this house. But if they have to sell before buying, somebody else is going to, win that house. And
And Janice,
we're
who
here to
wins
help
the
them.
bid? Who wins the bid who wins the bid when there's multiple bids?
No, usually it's somebody who, one, is definitely not contingent to sell before buying, right? And has a strong offer.
Strongest offer. So this program is strongest offer.
Strongest
Yeah.
offer, right? And if they're giving a big down payment, which usually if they have that equity, we can be like, hey, here's $400,000 down. We're going to close at the same time. And many of you on the call might be wondering, well, how long does it take to close something like this? Tanner, you know how long that takes to close these, right? Because we both closed a lot of bridge loans.
Yeah, I'm so excited to talk about this program. Like you said, I'm closing 5 bridge loans this month, or at least that's the plan. Might have one spill over into next, but TRID is really our biggest hang up on bridge loans, right? Obviously, appraisals play a role as well, but with the cash out refi portion of this, and most of these being owner occupied, we do have to abide by rescission. So that obviously loses us, 4 days on the back end. But just like with all our loans, we're really industry leading in non-QM as far as turn times. So typically it's taken 3 to 4 weeks. I always tell people set your contracts 30 days, right? We should be able to beat that. Sometimes there's some hangups that happen, if an appraisal gets pushed and there's really nothing anybody can do about that. But typically 25, 30 days is where we're closing these in.
Guys, William wants to know if
Yep.
bridge loans
Yep.
are for primary residence or for investment properties or both.
Both.
Mhm.
So quick example, the difference between them will be what Tanner just spoke about, the rescission period. We won't have that on an investment property, but we would on the primary. I closed a bridge loan for an investment property. Somebody was selling their house in Los Angeles and buying an investment property in Utah. So it can work both ways. The LTV is going to be what's going to be also different for investment properties. Max LTV on the home they're selling is going to be lower than if you were doing this on a primary.
Yeah,
and dare I say it,
yeah, we go owner
yeah,
occupied
they're
investment, right?
yeah. And
Kristen,
in this case, this was a reverse 1031 exchange. Boom.
actually, that was a
You
question
said
from
it.
Stu. Does this work for a reverse 1031 exchange?
It does. It does. The paperwork and the legal documentation has to be reviewed by legal. So it is a more complex loan. But if you have that situation come up, you contact your account executive and they'll help you and walk you through what's going to be required.
A lot of hoops to jump through, but yeah, we close them.
This is
Yeah.
really a simple way to be able to talk about this loan and explain it to your realtors.
Yeah, 100%. So
Oh, yeah.
hit on this, right? But to really kind of boil it down to its simplest form, we're doing a short-term, right, 1-year loan, 12-month loan on their departing residence to achieve the cash out that they need for the down payment on the new house that they intend to buy. So Janice alluded to this, no monthly payments due on that bridge loan, right? So we're giving you access to your equity, but you don't also need to be able to afford to make 2 mortgage payments on 2 primaries, right? You just got to be able to afford the new house that you're buying and your other existing, debts on credit. But we do everything we can to make this simple. We're saying, look, this house is going to be sold in a couple months anyway. We're not going to have any payments due. We're not going to hit the DTI for it. We're just allowing you to get into this new house in a very hassle-free way. And there's a lot of different benefits that we can talk about, on what this allows us to do. So let's hop over to this.
Well, they only move out once instead of, twice sometimes. If you have to sell your house before you move into the new one that you're buying, where are you putting your things? Where are you going to live, right? There's a lot of things, and Tanner's going to talk a little bit about how it's cost effective too, and also it's just more comfortable. One thing to note is, you might be wondering, well, what does this cost, right? It does cost something, and the rate on the departure on the bridge is 8.5%. It's interest only though, and it accumulates. And then once we're paid off, that interest is paid off as well. So that's how we are able to do no payments due until the house is sold, and they have a whole year to do that. Most of the homes though, they sell within a couple months or sooner. It's just going to depend. But yeah, it's a great program, and it gives a lot of
Hey Janice,
opportunity
if
to
I'm the
also
borrower, do I want my realtor to sell the house sooner or later?
sooner for the most money possible.
Good
Right?
answer.
So if maybe, yeah, right. If that house, like for example, is going to sell much better if you give it a little coat of paint, maybe
Hmm.
stage it, uh, you take out your personal items. Usually homes sell better and quicker once they look like it's a house for anybody to buy, right? But if somebody's going in and touring a house that's full of, the other personal items and knickknacks, and maybe it needs a little bit TLC, the, people don't tend to grab those as quickly as they do the ones that are nicely staged. So there's a lot of reasons to do this type of loan. But yeah, you want to sell the house fast for the most money, right?
Janice, is this program allowed in Texas?
That is a great, yeah, that is a great
No,
question. And yeah, now, Tanner, have you done one, or do you know if we could do at
Not
least
non-owner,
for
non-owner only.
investment?
yeah,
That's
we can
what I
do
was
them
going
for.
to say.
We can do the bridge in another state if they're moving to Texas, right? We do the purchase loan in Texas. The actual bridge loan itself, the cash out refi, can't be done in Texas because they have laws regarding balloon payments on owner occupied transactions. So no way to get around it
Exactly.
there. But if it's an investment to
Yeah.
investment, or the actual bridge loan itself is out of state, and the purchase in Texas, then we can do it.
Yeah, if
Um,
they're selling their house in Cali and moving to Texas, you got a bridge loan there.
Guys, Mike wants to know, why would a borrower use this program over a HELOC?
It's a great question. The
Yeah.
primary reason is DTI, right? If you do that, you have to qualify for their existing first mortgage plus the HELOC plus the new payment. You have to get a renter lined up, right? And get a lease agreement, first month's deposit, and really, move out and get that renter in there as soon as possible, right? As opposed to on the bridge loan where you're saying, you know what, I own both properties. I can move at my own pace, right? I can move, half of my house this weekend and the other half the next weekend, depending on the availability of my family and who can help and things of that sort. It's just, it's easier and more simple to qualify than having to jump through the hoops with the, departing lease agreement.
Guys, by
And who wants to make two payments, right? On the purchase and on the departing house. Because who knows,
Three,
right? Like Tanner said, you'd have to get a tenant in there.
three,
Three payments because of the
three
HELOC.
payments.
Yeah.
You qualify, you're got a large monthly expense there between those three payments.
Guys, so this is related to what you guys were just talking about. So Kate wants to know, by doing this bridge loan, does that eliminate the cost of the current mortgage, which I think you guys just addressed that,
Yes.
from their
Yes,
DTI,
it does.
and give them the equity to put towards the down payment? Or is it just giving them the money for the down payment?
Good question. So yeah, we do pay off any existing liens, right? So whether it's just a first or a first and a second, we'll pay those off. Our lien will be the only lien on the departing. And as far as the cash out piece of it, we can pull out more than we need technically. If we're doing debt consolidation to get the DTI in line, if we're pulling out a little bit of extra so that the borrower can buy furniture, pay for moving costs, right? Things of that sort, we can do that as well.
Now, I've got a couple of people asking about the permanent and the bridge loan together. So do we have to do
Yeah.
both loans?
Yes. Yes, LendSure would like you, obviously, to get that purchase loan done. It also, think about this, what other lender is going to ignore the fact that they have another loan out with us? So the short answer to that is we would close both loans if they come in hand.
We basically don't make any money on the bridge. We do the bridge to enable the purchase, right? And it is a non-QM loan. It is non-QM rates. I tell people, look, rates are probably headed down over the next year anyway. So even if you close them in a conforming loan today, you're probably going to be able to refi them in a year anyway and do a lower rate. So, if they're going to refi anyway, if they're going to sell this departing house and net a bunch of cash and want to bring that cash in to quote unquote do a recast, you do a cash in rate and term refi into a conforming loan. once the EPO is up, and you get them back into kind of a long-term permanent solution. So let's look at a couple of these bullet points here, and talk about some more stuff, because I think this might answer some of the questions kind of as we go along here. But one of the largest things about the bridge loan that we haven't hit on super strong is the non-contingency piece. And I'll give you an example as to why. The bridge loan works really well in both a buyer's and a seller's market. So if you rewind about a year and a half ago, rates were still low, the market was booming, right? You could list your home and get 10 offers in a week. The problem was you also had to compete with 10 offers on the purchase end, right? And if your offer was contingent, you weren't even getting looked at. You weren't even getting considered. So I actually closed a bridge loan in January and a bridge loan in February of last year when the market was super hot. And it was simply for the non-contingency piece on the offer. That was the primary driving factor in why we did those loans. So the ability to utilize this program, no matter what the market looks like, no matter what the situation is, non-contingency is a fantastic thing that you can utilize to negotiate seller concessions, right? More favorable close of escrows and different things that you want, that you're utilizing your non-contingency to help negotiate.
Yeah.
We talked about paying off the existing liens, right? Using that equity as a down payment. We talked about pulling out a little bit more cash if you need it for other things. No ticking clock is a huge one. You're buying yourself the luxury of convenience and time. So there's kind of two ways that this applies, both in the, oh, I found my dream home and I want to buy it right now, but I need to find a seller or sorry, a buyer for my house that I'm selling, right? Or on the flip side where, oh, I got my departing under contract. Now I got to go under contract on a purchase like soon, like within a week, right? And maybe you don't find your dream house within a week. You don't have a ticking clock. You're able to do things at your own pace, which is really, really nice.
I'm gonna interject there. That's true. And just so everybody knows, if you know a borrower right now, they're looking to sell their house and buy another one, they don't have to have found it to get the ball rolling with us. So we can do a TBD pre-approval, and we would pre-approve both the purchase and the bridge loan. And now they go shopping with confidence, being like, I know I'm not contingent, and this is what I qualify for, and I think sometimes that's extremely valuable. Now, most bridge loans I've done, I don't know about you, Tanner, it's I found my dream home, I need it now. So then we're running, right? We're like, okay, let's go. But a few times I have had the ones where they took the time to say, I know this is my situation and this is what I need. And they get TBD pre-approved for the bridge loan and for the purchase, and they go shopping, and then we're ready to rock and roll as soon as they find that house. And I've closed, I think the fastest bridge loan was in 21 days. Now I'm telling you, we had all our ducks. Yeah. We had all our ducks in a row, right? 21 days is pretty fast. There are two appraisals, one on the purchase and one on the departing home, depending on the loan amount, right? I've done them where if I think it's over 1.5 million, you need two appraisals. But it is two separate loans, and that's the second to last bullet point. Then I just kind of interrupted Tanner on, but it is two loans, two LEs, two CDs, two 1003s. It's kind of like BOGO. you buy one, get one free.
Janice, I got a
It's almost
question.
sure.
I got a question about whether they get paid on both loans.
That is a great question. And the answer is you definitely get paid on the purchase, your full commission. Or sometimes I have LOs increase their commission to get a little bit more. On the departing home, if it's a primary, which most bridge loans end up being, we are subject to Section 32, so the high cost threshold. And there is points that LendSure charges on the bridge loan. So because it's a one-year balloon, it's a higher rate, and we also have to charge our lender fee. Sometimes you can't charge. Now, it could be a quarter, half a point. It's going to depend on the loan amount and the situation. So we would check that and let you know if you're able to make money on the departing home. But think about this, that might make the difference between you getting the purchase loan or not. So I kind of see it as it's the same income documentation, same borrower, and you get to solidify that purchase. So in the worst case scenario, if we can't get you to charge, yeah, go ahead, Jim.
why don't you guys talk to the for sale sign in the yards of America? What does that for sale sign mean?
That's on the next slide, I think. But I want to follow up on what Janice said,
Sorry.
because I think it's really important to talk about. So when we look at this potential loan, right? Let's say right now you have a borrower with a TBD approval in hand from you, and they just need to sell their departing, right? And it's been what, 30 days, 60 days, 90 days that they're waiting to sell that departing. They don't like any of the offers they're getting. You know, they want to wait until the market heats back up, right? So you go from your TBD, your one loan, maybe if their departing ever goes under contract, to the potential for 4 loans. And I'll tell you why. You have the bridge loan, right, on the departing that Janice mentioned. Based on section 32, you might be able to make something on. You have the purchase loan. Janice mentioned you can raise your comp there potentially, right? You have the refi of the purchase loan that I talked about 8, 10, 12 months down the line when you go to put them back into a conforming loan. And then you even have the potential refi on the bridge loan, right? Let's say the borrower decides, you know what, I don't want to sell it. I still don't like the offers I'm getting, right? Our balloon is about to come up. We can refi them into an investment loan, you know, as kind of a last resort, where, you know, they're not stuck holding that balloon, right? And say, oh, I got to come up with 300 grand now out of nowhere, right? If they can't sell it or don't want to sell it, we can always refi them into an investment in a worst case scenario. So that's a potential for 4 loans for you when you had 1 maybe, right? So I do think the benefit is there, even if you aren't able to charge as much on the bridge as you want to.
Guys, I'm getting a ton of
True,
questions
and that
about, oh, I'm sorry, Janice. I'm getting a ton of questions about maximum LTVs, maximum loan sizes, and minimum FICOs. Can we address that real quick? On the bridge loan.
yes,
Yeah.
Tanner.
So the max LTV is going to be 75, but we really want to try to stay to 70 when we can. You know, especially when you start talking about declining markets and things of that sort. The fact that we don't have any payments due on the bridge means that at the end of the 12 months, our LTV is 8.5% higher because it's an 8.5% rate, right? So if you combo that with a downturn in the market, really puts us in a scary position on LTV. So we try to stay away from 75 unless we absolutely need it, and we're in a really, really strong market, you know, in a place where we really know like there's not going to be a huge downturn. As far as the purchase loan, it's a maximum 80 LTV, so they need to put at least 20% down. And the FICO minimum is technically 680. I really think we can get away with 660 with good compensating factors and some exception pricing, sometimes even lower. So, you know, this goes back to what we were talking about with Jim, where we say we do loans that make sense, right? There's a lot of different reasons a credit report might be lower, and no 2 credit reports are the same.
And it's worth noting as well. So, and just for those of you who are a little bit more visual, if it's $1 million house, we can do $700,000 loan amount or 750, right? Depending, like Tanner said. And if they have a lien on it, let's say 300,000, we pay off that lien. And then what's remaining, we can use for the down payment, for closing costs, for, like Tanner mentioned, maybe they want a little, you know, money to pay down debt, to get their DTI in line or things of that nature. But I wanted to touch upon the fact that one of my bridge loans turned into 3 loans, 2 purchase and 1 bridge. So the LO charged on both purchases. And that was because they had so much equity and they were moved down buyers that they're kind of like, well, what do we do with the rest of this equity? And the LO said, why don't you buy an investment property? Right. So it was a triple loan at the, you know, so they got paid on both purchases. So there's a lot of things that can be done with these. Rose, did we touch upon all the points to that question on LTV?
I had lots of people ask about that. And we covered the FICO, we covered the LTV. What about loan size? How much? What's the maximum loan size on a bridge loan?
I would suspect we like to keep it at $1.5 million. I've gone higher, but it's always case by case. But you can go pretty high, right? Tanner, anything you want to add?
Max loan size is always a fun guideline to talk about because we exceed it all the time when our LTVs are low. sense, right?
Yeah.
There's some guidelines that are really hard and fast, and like we kind of just don't ever stray from them. There's a lot of guidelines that we stray from pretty commonly when the compensating factors are present. Max loan size, max cash out are 2 examples of that. So like DSCR, for example, which we talked about last week, max cash out is 500K, but if you're pulling $1 million out on a $2.5 million home, we're going to do that all day long, right? Because the LTV is fantastic. It doesn't even matter that it's exceeding our max cash out guideline technically. So
Yeah. If you have one that exceeds our loan amount, just let your account executive know, and they can, you know, make sure that we're able to do the loan for you. Also for investment properties, if memory serves me right, it's 65 LTV on the departing home, max LTV, and on the purchase it's 70 or 75. Yeah.
So
All right.
jumping back into these bullets, just to try to finish out this slide here. We can do any kind of documentation we need to do on the purchase. You know, we see these as full doc quite often because they're very straightforward Fannie Freddie borrowers that are just utilizing our bridge loan to get into the new house. But we can also do asset depletion, which is something I've seen, especially on the move downs, where you have a borrower that's, you know, retirement age and wants to get something more modest. They own the house free and clear, and so we pull out 70, 75 when we really only need to pull out like 30 or 35%. And the reason we're pulling out so much is because we're using that extra cash to deplete from in combination with their Social Security income so that they can afford the new house that they're trying to get into.
Yeah.
So we see that quite a bit. The bank statements we talked about last week, we can combine, mix and match different types of income. So a lot of options there. As we've kind of mentioned, these loans are kind of hand in hand, right? They close same day, they sign same day. The money from the bridge never actually hits the borrower's account. It just goes to title, and title applies it to the purchase. So it's not like you do the bridge and then you get the money and then you go shopping, right? We pre-approve you, we execute these loans at the same time. So because of that, escrow can sometimes give discounts, considering that, you know, both things are happening simultaneously.
And it's important to try and open escrow. Yeah, escrow with the same company, it really helps if when possible.
Yeah, sometimes we're moving states and that's not an option, right? But yeah, when you can do escrow with the same company, it's very beneficial. And then this last bullet I'd love to talk about, because we've talked a lot about, you know, some of the other benefits, and we talked about the costs. I want to talk about offsetting the costs, because one of the very first things that's going to happen when you talk about this loan to borrowers is they're going to get sticker shock, and they're going to be like, oh, well, it's a whole separate loan and it has a whole separate set of closing costs, and I got to get an appraisal on my departing now, and right, there's points and all this stuff. They're going to be like, ah, it's too expensive. But really what you need to do is you need to educate them on what kind of the goal is here on the sale of their home. So first of all, I already talked about the non-contingent offers and negotiating seller concessions, right? That can be huge for helping get some of the closing costs covered. But really what we're trying to do here is we're trying to reach for a higher sales price on the departing. So Janice talked about how a lot of hers have been like, panic, oh my gosh, this is my dream home, we need to go, 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 right? Well, if you do that and you also are still trying to sell your departing house, what are you doing to get that sold? You're slashing your sales price. You're offering seller concessions. You're doing everything you can to get it sold ASAP, right? Now, it needs to sell now. Versus if you do the bridge loan and some of the other strategies Janice talked about, where you put down a fresh coat of paint, you stage the home, you really make the realtor earn their keep. You have them hold open houses on the weekend, right? And you get people into a bidding war such that seller concessions are no longer needed. And you've swung the sales price some 20, 30, 40 grand to cover all of these costs associated with the bridge loan, and in some cases even come out on top. You walk away the winner and you pocket some money. So the swing in sales price is so important to talk about, because borrowers just think sometimes, oh, well, just my house sells for what it's worth. And that's it. That's the end of the conversation. And we know that's not true. The house will sell for a very different amount depending on the situation and how it's marketed, right? So that is a strategy that you can utilize and really need to explain to the borrower for them to understand the benefit of this loan and how we can offset the costs. So one thing I do, and I know a ton of other AEs in our company do, is we say, hey, I'm willing to jump on a 3-way phone call with you and the borrower, right? Let's make sure they fully understand what's going on here, because we are the subject matter experts, and we definitely want to help explain things so that the borrower knows what the option is, right? And all the different facets of it, because there's a lot of moving parts. So we want to make sure they fully understand it so that they can make an informed decision, right?
Yeah, and Tanner, I don't know if we ever said anything, but the bridge loan costs 2 points. And so that is where Tanner's saying people sometimes go, oh, I don't want to pay that, right? Many, many times we can get it out of the cash out from the bridge loan, so it's not felt. And gosh, the benefits to selling your house for what you want to sell it versus what you have to sell it for is usually, right on the money, basically. No pun intended. Talking points that I think, Rose, this is a great one for you to kind of talk about. But how do you tell a
Yeah.
realtor about this or borrower about this program?
First of all, I know I've got a ton of questions asking, because I know that we're covering a lot of stuff. Yes, you're going to get a copy of the
Yeah.
slide deck. Look for an email from me, Rose Waldy, about an hour after the webinar is done. It's going to include a link to the slide deck, to the marketing resources, and it's also going to have a recording of the webinar. If you want to share it with other people and pass it around, please feel free to do so. So what we did is we put together some talking points to kind of, if you're at a cocktail party or an elevator pitch to a realtor, just some quick points to kind of start the conversation about bridge loan. So remind them, you can find it and afford your dream house without having to use contingent offers, without costly equity loans and new liabilities, and without awkward conversations with family asking for like gifts to help you out. You can find and afford your dream house using the time you need. If you're in a contract to sell, you must buy while the clock is ticking. This is a huge advantage for the sellers and for realtors. Allows for quick close, front-loaded process, so most buyer conditions are handled before escrow is open. So again, these are things to just keep in mind when you're talking about the bridge loan. So now we put together an actual action plan for you guys, which I know that you're going to be very excited. So the webinar is called How to Sell Non-QM. Here's a step-by-step guide on how to do it. Janice and Tanner, I'm going to have you guys walk them through this wonderful process.
Well, I know Jim wanted to touch upon the for sale sign portion of this. So
You guys do it.
we do it. All right. Well, I mean, let's think about this. Every for sale sign is an opportunity, right? Where are they going? They're selling. Where are they going? Do they have somewhere they need to be? So that right there is one thing you can do. I mean, I love driving around and going to open houses, like just for fun. But you can do that too and go, hey, you're selling. What's the plan, right? So that, obviously using the internet, also Zillow and Realtor.com is going to help too. But this is, for me, this is the best action plan. Is how do you find clients? Well, they're selling. Hey, I can help you. You can buy before you sell, and that makes you stand out right there. So,
The days on market one here is really important, I think, to point out because, as Jan is saying, being there in person, right? Obviously very, very useful, but how do you figure out where to go, right? So yeah, you could drive around, look for sale signs. That's a great way. But one of the better ways I think is looking at days on market, right? As far as what's been listed on the MLS and has been out there for a while. They're obviously either not getting offers or not getting offers they like. And so that would be the perfect situation where frustration is definitely mounting, right? They would love to get out of that house and get into a new one. And that is kind of just filter it, right, by most days on market to least, and start at the top of the list and start working your way down. And you're going to find somebody who the bridge loan would be a perfect option for.
Yeah.
Question, Tanner. As you guys have explained, a powerful program here. If I'm a loan officer and I've been trying to call on realtors for business, and it takes a while to establish that realtor relationship, is this one great program to get in front of realtors that you've had a tough time getting in front of?
Yeah, absolutely. Well, I mean, this is front of mind with realtors, right, in their day-to-day, talking about how much can we sell it for, what's our timeline look like to sell, selling so that we can buy, right? Maybe I'm the buyer's agent, but they got a list with the seller's agent first. So, this is in their day-to-day, it's in their wheelhouse, right? When you talk about getting financing, that's just standard stuff, right? Or the full doc, bank statements, we have to go asset depletion. We talk about a bridge loan, you start to really involve the realtors in the process and start getting their minds, right, the cogs in the head turning about, oh my gosh, look at what this would allow us to do and what we would be able to achieve using this loan. So it's a phenomenal excuse to get back in front of your realtors. You're almost always going to get people that are, at least want to hear you out when you talk about bridge loans. And you know, it's great to segue that, right, and utilize that to springboard into deeper conversations. But it's a phenomenal thing to market, right, an attention grabber to kind of say, because bridge loans have been around for a while. There's different ways that people do them. You know, hard money bridge loans don't often look exactly like this. So, you know, when you really explain that I have a bridge loan with no debt obligation, right, and really start getting into the minutia of how this loan works, it's very new and different for realtors, and they end up loving the program.
It's a great way to catch their attention again if they haven't been sending you deals. That's bottom line, is call them up and say, hey, I have a program you're going to love.
It's a door opener.
Yep, door opener.
Now, here is the good stuff. This is when you get a copy of the slide deck, each one of these is a link to these resources. So I'm providing you with flyers on it, email templates that you can start using right away, even a slide deck that you can, if you want to do a presentation to a realtor office on how this program works, you can use this slide deck. Here's some social media graphics, and just, you know, use stick your logo on here, put them on social media and get the attention. So here's everything that you need to start generating new business right away. And we've got let's see, we've got a ton of additional questions on the bridge, which is to be expected. We're going to move on right now to condo hotels. We're going to get back to bridge loans if time permitting. But after the webinar, remember, you're going to get a copy of the slide deck, and I'm also going to send you some information, additional information and stuff on the bridge loan itself. So you'll have that in that email itself. So let's move on to.
If you have questions that we don't have time to get to, definitely reach out to your account executive. They're very knowledgeable and can help you out, especially if you have scenarios in mind. So don't forget that as well. But yeah, running thin on time here. Let's talk about condo hotels. So for those of you that don't know what a condo hotel is, it's really a hotel room that you can own, a hotel room that you can buy, right? So
with a kitchen.
With the kitchen, yeah. They'll enjoy all the normal amenities and services of a hotel. Really the main thing that determines what a condo hotel is the rental pool, right? Do I have the ability to walk up to a front desk and book a room for the night? And one of those rooms is a room that's owned by an individual, not by the hotel itself, right? So when the HOA essentially manages the nightly and weekly booking of the rooms, that's what we consider to be a condo hotel. So there's a ton of these in Florida. More recently, urban centers like Chicago, New York, Boston have gotten a lot of them, and there's tons in really any second home destination. So you talk about, you know, lakes like Lake Powell. You talk about ski resorts and destinations like Breckenridge or Park City. You know, you talk about coastal destinations like San Diego and coast of Texas and things like that. There's going to be condo hotels in all of those places.
And it's important to note really that it's not very common to get financing on these type of properties, right? So that's what makes it unique. That's what's going to help you stand out. It's like a lot of times people are having to pay cash because they don't know they could get financing, and you know, you can swoop right in there and offer them an alternative, right? Even though down payment's a little bit higher than our, you know, not conventional, but our other loans, condo hotels are still a great solution to help, you know, find financing.
Yeah, I think we talked about this last week when we were talking about foreign nationals. The two most commonly held kind of properties or situations for all cash is going to be condo hotels and then foreign nationals that own properties.
Exactly.
Because they just don't know financing exists, right? They just buy it in cash. So on our next slide here, a little bit about our condo hotel program, the guidelines. So again, rental pool is really our focal point here in determining what a condo hotel is. We'll go up to 75 LTV on purchases, 70 for rate and term, and 65 for cash out. And obviously that cash out being one to definitely talk about for the people that are buying these in cash. We do have delayed financing as well if they bought recently in cash. Minimum FICO 680. I actually just got one approved at 660. So just like with other programs, we'll go down a little lower if we got good compensating factors. 1 point origination to LendSure. So along with our bridge loan, this is the only other program that we charge origination on, just because it is such a niche product and it really needs to make sense for us to do them. Now, we always want to stay above 600 square feet. That's a really important number. Above 600 square feet is much, much easier than below 600 square feet. And we always want a full kitchen. So when I say full kitchen, I don't necessarily mean like a stove, right? What I mean is as full as we can get. I want a full size fridge, not a mini fridge, or even like a slim fridge or like a half fridge combo with like a half freezer, right? Those types of things. I want a sink. I want stovetops, right? Burner plates. An oven would be great, right? A dishwasher, like just, it should look like a kitchen. It should feel like a kitchen, right? The more it feels like a condo and the less it feels like a hotel room, the better off
The
we are.
better, yeah.
If I have a countertop with a microwave and a mini fridge in the corner, that's not going to fly in a lot of cases. So, you know, I've done condotels as low as 300 and some odd square feet when it has this full built out, you know, professional looking kitchen. And you know, there's some condotels that are even over 600 square feet, but don't have, you know, those types of things, and it's much harder to get those done. We're looking closer to like 50 LTVs in those kinds of cases. So we have done these more hotel room like units, but it's a very, very case by case basis. You got to have a brick of gold borrower and a very, very large down payment.
Tanner, Michael wants to know if we can do a condotel as a primary residence.
Yeah, so per guidelines, no, I've done them. Again, has to make sense, right? If we're talking about somebody married with 3 kids that are ages 5 to 10, like the answer is no, you're not all gonna live in the hotel room, right? We gotta make sure there's no occupancy concerns. But you know, if I'm a single young person, or I'm, you know, old and retired, and I'm selling my house and it's already been sold by the time they go under contract on the condotel, and they're calling it a primary, we'll close it as a primary. You know, we may price up to price it as an investment, just as a worst case scenario. But you know, I have closed these as primaries when they make sense.
Okay. If there, Sue wants to know if it's a condo project without a front desk that allows daily, nightly rentals, but the owners can manage it themselves or put it in whatever management company they want, is like a regular condo. Can we call it a condotel?
We wouldn't want to. We'd call it a non-warrantable condo and we'd still close the loan, just at better terms, right? So I actually closed one of these in Park City where there was a front desk, but that front desk was really for the unit owners, right? It was like a concierge with, you know, towel service and things of that sort. But you couldn't actually like book rooms for the night, right? If you were to rent it out, because it did allow nightly, weekly rentals, you had to do that yourself, or you had to get a property management company involved. But the HOA wasn't actually managing it. So it sort of looked and felt like a condotel, but because it lacked the rental pool, we were able to call it a non-warrantable condo, and we still closed it. So the non-warrantable condo wouldn't have the 1 point origination. It would have a little bit more favorable LTVs and things of that sort. So we still do the loan. We wouldn't want to call it a condotel unless we had to.
Bettina wants to know how she would explain the difference between a condotel and a timeshare.
Ooh, good question. So timeshare is going to be more fractional ownership. You know, you don't actually own the unit yourself. You own it in conjunction with several other people. So timeshares we don't do. We have in limited cases lent on properties that were in the same building as timeshares. So for example, like 150 units, 10 of them are timeshares, our subject property is not. We'll probably do that loan. You know, the exposure there and the risk associated with, you know, the people that are owning the timeshares not paying the HOA, and the HOA experiencing financial problems as a result of that, is pretty low on 10 units out of 150, right? But we won't lend on timeshares ourselves.
Okay.
Opportunity knocking.
Yeah.
Knock, knock.
Yeah, yeah. Well, Tanner touched upon the locations, right? So, gosh, if you live near these locations or at them, that's a great way to go and hit up, you know, your contacts and say, I know where I can get financing, right? So, that's an opportunity. And you're looking usually at high-end places like South Florida, you know, so they're good loan sizes too. So, that's an opportunity for sure.
Yep.
And yeah, and Tanner touched upon that too. A lot of them are kind of more of the foreign national buyers too, because they're looking for something that's going to be rented for them. It's going to be managed. They're, you know, I like
Yeah.
them as second homes too, right? That's kind of also a nice, you go visit and then the hotel takes care of the rest. So.
Yeah, we see a lot of condotels on our foreign national program specifically for the exact reason Janice just mentioned, right? They don't have to do anything. It's managed by the HOA, but it's a hotel room that when they come to the US to visit, they can, stay in.
Yeah. Tanner, quick question, and people might be thinking about, well, how do I start getting in this type of market? Have you ever closed for the same LO in the same condotel several times over?
So you're saying closing in the same condotel project?
Yes.
Yeah. So I mean, it has to adhere by all of our normal guidelines as far as max exposure, right? LendSure won't fund any more than 25% of a project. So we need to pay attention to how many loans we've done. But so like, for example, I do a lot of my business out of Las Vegas, right? So I've closed a dozen loans in Palms Place, in MGM Signature, in Trump Tower, right? So I am closing multiple times for the same LO in those places. Yeah, it's a great revenue stream for the LO because they're getting in contact with the agents that are involved with those types of properties who traditionally have just been like, oh, well, it's hard money or cash. Those are your options, right? And now we
Yeah.
have a much more competitive option to offer.
Yeah, I
Willie
feel
wants
like
to
that
know-
there's an opportunity.
Willie wants to know if we can do our rate buy down with the condo hotels.
Yep, any of our programs. We just have to observe our floors.
All right, fantastic. So here are more of our marketing resources specifically for condotels. Again, if you click on the links within the slide deck that I send you after the webinar, this is going to take you to these flyers. And you can see these flyers, there's space, you can click on it, add your logo, add your disclaimers, add your contact info, email templates that you can do, social media graphics where you can add your logo, et cetera, and NMLS information within this so that you can start generating new business right away. Next, Jim, fix and flip. Talk to us about the fix and flip market.
The hottest. Before I mention fix and flip, great points made by Tanner and Janice. Those are two hot programs in themselves, and they gave you guys a lot of information on how to market that as well. So good job by you guys showing the ways to sell that product versus just what it is. So one of the hottest things going on in America today is this fix and flip, and it's busy for three reasons. Here's a thing we call the term sheet.
Is that a term sheet?
Here's 2 weeks. This is, I don't know, 35, 40 term sheets. It's like a pre-approval. So we're inundated with applications on this product every day. Why are loan officers and investors and realtors so busy with this product today? My first answer to that is LOs aren't as busy as they were 2 years ago, a year ago, because the refi business isn't there. So they're looking for ways to make loans. And one of the ways is the LOs are contacting realtors who in turn are looking for commissions, and they're trying to find investors, and they do. Realtors find investors. So both of those communities, they're not as busy as they were. They're looking for this loan and they're finding them. So we have competitors in this space that are literally closing 1,000 loans a month doing these fix and flip loans. So you can see the first bullet point, people are fleeing the urban life and looking for something different. They want to buy a house at under value, fix it up, either rent it. Eventually down the road, maybe they move into it. It's just a elevator speech that's happening today all across America, probably more busy, more demand East Coast than West Coast, but we're seeing these loans come in droves every day. So fix and flip at LendSure is simple. We want to write a loan for an investor who wants to buy a house that needs work. So buy, fix, sell. It's not a fix and move into it type of a loan. It's
Nope.
fix, buy, sell. The other alternative is fix, buy, hold, meaning contact your AE, either Janice or Tanner or whoever you work with. At the end of the project, they can take the option of renting their property out and getting a very easy, streamlined DSCR loan working with your account executive. So that happens in many cases. They don't have to be sold. They can be turned into rentals. We look for projects that make sense. A fix and flip loan is weighed heavily on its location. There's no income on income analysis. There's no 1003. If you've never done a fix and flip loan, the first thing you learn is, wow, no 1003, no IRLA. And next thing you learn is there's no disclosures, there's no TRID, there's no ATR, there's no prepayment penalties, there's no EPO. So it's a different kind of a loan. It's a commercial note that we have the borrower sign, and it's an easy underwrite. So what do we underwrite if there's no income? We look for a credit score of 680. Can we get less? Tanner mentioned how we do that. Yes, we can go under 680. Depends on the compensating factors. On a fix and flip loan, that would mean how hot is the project? So it's location, a credit score, and we ask for one bank statement, maybe two, to show that they have assets for the down payment, assets to get the project completed. The underwrite is the property itself. What's the address? What condition is the house in? Have you had your contractor walk through it and give you a list of repairs of what's needed? So we're going to put a lot of weight on location. Our only out with the fix and flip loan is it sells. We don't know where the investor works. We don't know what their income is. We have no clue. All we know is this house has to sell. It's a 1-year note. It is our only takeout. So we're going to underwrite the property closely, meaning would we do a fix and flip loan 5 miles north of Joshua Tree in the desert of California? No, we won't do that because there's no buyers. We're looking for residential communities, neighborhoods where there's a lot of buyers looking to get into that neighborhood. Average loan size on these is 300 to 400,000. We see some in California, some in Florida, over $1 million, but the typical play is 300,000. How much do we lend? That question always comes up. So in fix and flip, it's not a loan to value. I came up in the business. You guys came up in the business. It's all about loan to value. In this world, it's loan to cost, meaning there's two costs that the investor incurs. The first cost is his acquisition price of the project. Let's just say he finds a house that he can buy for $500,000 somewhere in Tampa, Florida. The contractor and investor decide the house needs $100,000 in repairs to increase its value to a number where they can make some money. So $500 to buy it, $100 to repair it, that's $600,000. So the first test is how much of that $600,000 will we lend? An experienced flipper, someone that's been down the road, 85% of that is the amount of money we'll lend them. We'll lend them enough money on day one to buy it. And then the construction cost, in this case, if the LTV on the front, the down payment on the front end is correct, they can get 100% of the construction cost. That is held back and paid out in the form of draws as the project moves down the line. We never hand somebody $200,000 and then say, go finish it. Sometimes they'd take the $200,000 and be gone. So we don't do that. It's paid out in the form of draws. So that's the test on how much will we lend. The second test is, you hear this term, ARV. What's the ARV? What's ARV? After rehab value. So the investor wants to make money on the project, or why do this? They're not moving in. It's all about profit turn. 600,000 in, they got an ARV of 800,000. How do we know it's 800,000? Back to your business, comps. Comparable market values. What in the neighborhood is sold for $800,000? If the investor sees that and we see that, we're okay to go with the loan. We limit the ARV amount to 70% of the after rehab value. So on an $800,000 ARV on a $600K in, you're fine. That'd be plenty of room.
Okay.
Why is the loan good for loan officers? Repeat business. Tanner was talking about in a bridge loan scenario, you can make up to 4 loans. In the fix and flip world, an investor is good as his next project. That's all they do. They make money on each flip. They're looking for financing, not only on this property, they want financing for the next one and the next one and the next one. So great repeat business for you, multiple transactions, can occur. We did 3 loan approvals, closed 2 of them for a broker in Utah last month. So we're seeing this repeat business take on. It takes on fast. It goes quick.
And Jim, wouldn't they also, if they end up deciding to hold the property, do another loan, refi out of the fix and flip into like a DSCR, right?
That does happen. And what's easy about that is we already know the client. The only test on the DSCR is, do the market rents cover the payment? Same as we do on any DSCR loan.
And there's less of a seasoning, right? We don't have a seasoning period if once they fixed it up, they wanted to refinance into a DSCR with us, if it's rate and term.
We will use the new market value, but we will get a new appraisal at that point in time to look at the market rents at that point in time. It's more market rent driven than it is value driven. So
Bingo.
that's another strategy. It's 2 loans. Then with those funds, they're looking for their next flip.
Jim, what are the advantages of using this fix and flip program as opposed to hard money loans?
Fix and flip rates are hard money rates, and we're not shy about talking about our rates. Rates in fix and flip start. Some companies are at 9, some are at 10, but generally speaking, it's a 9% business to 12% business. The rates vary based on the risk in the project. Credit score has a little bearing on the interest rate. The beauty of the interest rate is it's a 6-month loan. It's a 9-month loan. They're looking to sell the house and pay it off, or they're looking to convert it to a rental. So that interest rate is very short term. We don't run into, I don't hear interest rate as much as I hear points. Yes, there's a point cost when you do these loans. LendSure makes money on its points more so than the interest rate. As we all know as mortgage bankers, loans that pay off that fast don't get a lot of premium from Wall Street. They don't want loans that pay off. So we make our money not on the interest, we make our money on the points. So points, Rose, is more sensitive than rate. And we urge our LOs to have that conversation up front with their investors.
Donald wants to know what the appraisal process is like.
Appraisal is ordered after the term sheet is signed by the investor and returned. And the appraiser are specialized people that are going to look at 2 things: the house and the scope of work, meaning what's the contract say about doing the repairs. We call it a scope of work. It's just a contractor estimate. Some people call them the CE. The appraiser, these guys are normally trained in the construction trades. They'll look at the scope of work, look at the house, and can envision what it is after the project's done. Now give me a fair market value based on a house that looks like that on this street. So there is an appraisal involved, and we look at the ARV knowledge from the appraiser.
Okay. Is this an interest-only loan?
12-month note, interest only. There's what other fees are involved? People ask me that question all the time. What are the other fees? There's one $600 fee called the scope of work inspection fee. So we're going to look at the scope of work with an outside company to make sure it makes sense for the project. Are we not over improving the neighborhood? Are we spending enough money to get the house to this new elevated value? So that's a fee. And then the LendSure underwriting fee / processing fee is $1,500.
Okay. So talk to us a little bit about the program guidelines.
So I mentioned the loan to cost up to 85% for experienced investors. What's an experienced investor? They've completed 4 projects in the last 30 months. Or they've completed, I had one last week, he completed 150 projects, but only 2 in the last 30 months. We treated that guy as a professional investor, 150 deals. So he would get 85%. We don't say no to first-time investors. Some of our peers do, because it's a risky business. You learn the hard way sometimes in this business. We'll look at them, but the loan to cost is reduced. As you can see on the slide, it's going to be 70% versus 85. So they're going to have a little bit more down payment in, but we say yes to them, and when a lot of people say no.
And Wendy wants to know if the flipper can also be their own general contractor.
Yes, self-improved. We allow that. Some peers do not. If the buyer, the investor, is a licensed general contractor. We'll allow self-performing, but we are going to use that inspection I talked about, the SOW, scope of work inspection, with a third party, which is $600. We're going to use that in close contact with this person who's going to do his own work. We allow it, many people do not. Good question.
All right.
Another niche that we can talk about that we do that others shy away from. Projects midterm, not completed, 18 months into the deal, house still isn't done. Construction's half done. What happened? Many people say no to that. They're worried about something to do with lack of funds on behalf of the investor. He took out a mortgage. Oh my gosh, the mortgage must be past due. It's in demand. Why do we want to enter this project in midstream and bail somebody out? Even if there's no mortgage, they will shy away from them. If there's no mortgage and the project stalled, we're going to get an LOE and try to understand why and how, what occurred. If it makes sense, there's a value there of some number, even in its not complete state, we're going to make a loan to get them down the road to complete the project to achieve the ARV. So when you hear about, oh, I got a project that's stuck, it's in mid-construction, LendSure will take a look at that. We just closed one last week in the great state of North Carolina. New build home, roof on, framed, windows in, nothing else. And it sat that way for 9 months. We were able to get the project back on track. And as we speak today, there are crews back on the job.
What options do we have for compensation when income, and where is it on the term sheet?
Sorry, Rose, I didn't get the question.
About compensation, what options do we have for our comp, and where is it on the term sheet?
So we list broker comp on page 2. Typically, brokers, what I see on most of these is 2 points. We're going to charge 1 to 2 points. Large loan size, $1 million deals, $900,000 deal, 1 point. Small deals, 200,000, we're going to be 2 points. So that's listed on the terms, page 2 top. In some cases, and not higher than 70 LTV, we will finance broker points into the deal, just like the other programs that Tanner and Janice talked to you about the last 2 weeks. So if you're at 70 LTV, we can stack finance 2 points into the deal to help you cover those points.
And I'm going to jump in, Jim, on our side, when we get calls on, hey, I have a fix and flip scenario. The slide really speaks to what you should know, because like Jim said, there's no 1003, there's no LE. What is there? How do you get an application started so you can get a term sheet? You apply online and you ask your AE for that link. You just click on it and it's going to ask some questions. And so it's really important. I'm learning from experience myself. When an LO fills that out, right? When you're sitting down filling it out, what are you going to ask your borrower? What level of experience do you have, right? Putting no experience will affect the way it's approved, because they're more aggressive, right? LTVs, when the borrower has done several flips. So really knowing that answer is actually going to make a difference on how your approval is going to turn out. What's the property address? Jim touched upon that. This is really about the property, right? So if you're like, it's TBD, then you're not really ready for a term sheet, right? So have, well, this comes up, right? When it's your first one,
Right.
You're like, I don't know. So that's the one you have to know. Property address. Does your borrower have experience doing flips? And also knowing the scope of work. Jim touched upon all of this, right? But if you have this information up front, you're able to fill out that application, click the button, and Jim, what happens after that? What happens after somebody applies?
The second they hit the submit button, that registers on 2 screens, my counterpart on the East Coast and my screen here. And we see it come in the minute they hit submit. We may not respond to it for an hour or 2 hours or 6 hours. We'd promise a turn time to get a term sheet out of 24 to 48 hours. We make that in most cases. However, I apologize because that's not happened in the last, call it, week and a half or so. We've been
Because you're
slammed.
slammed. Yeah.
We're behind the 8 ball. In fact, I got to get off this call now and go answer 5 new deals because people want answers. So typically 24 to 48 hours to a term sheet. What speeds up the process? An accurate application, which is fill in the blanks, and it's about 25 questions. It's a lot shorter than an URLA. So an accurate application and your scope of work. So by this point in time, you've found an address. You're going to know. You should want to know as an investor, what's it going to cost to fix it? So you've walked their property with your contractor. Include that 1 or 2 page scope of work. That'll move your application ahead of all the other ones. And the big key, if your property, one of the questions is the property purchase contract signed? Is it signed? Oh yeah, this deal's already signed. The sellers agreed to sell at an X price. Many are not signed. They're trying to figure out what's my terms before I make an offer. If it says purchase contract signed, that's first class treatment on any airline. They're going to get service first. Those come in as hot.
Go ahead.
No, go ahead, Janet, please.
Oh, I was just going to say that makes a big difference, right? Knowing what happens behind the scenes. So if you're looking to get this kind of business, these are the things that are going to help you get quicker, more efficient answers. And really, when Jim says 25 questions, I've read this application many times to my LOs. You know, a lot of them are borrower's name, you know, does they have experience? It's yes or no kind of answers. So it goes by really fast, and it's easy once you know what what we're getting
Most
into.
of it's yes or no. It's like, have you had a foreclosure? Yes, no. Have you had a bankruptcy? Yes, no. Some of that stuff is easy to fill out. What's their credit score? We don't even ask you for the credit report. All we ask you for up front is the credit score. We'll get a credit report downstream, but to get the ball rolling, all we need to know is the middle score.
Jim,
LLCs. I didn't touch on LLCs. So this is an entity-based loan. There's no loans made to personal names. So corporations, LLCs, is the only way we'll fund the loan.
That was a question from Martin, actually, that was on my radar. He wants to know, for fix and flip, can the purchaser be an individual? And you're saying no, they cannot.
99.9% of the time, no.
What's our most popular product right now? Is it fix and flip?
Well, I only see fix and flip deals. So we're slammed, I know that. That would be a better question for Janice or Tanner.
It depends on where your kind of market is, but I would definitely say right now I'm seeing a lot of self-employed bank statement deals myself.
Yeah,
Tanner,
and it
bridge
depends.
loans.
Yeah, for me it's bridge loans, right? 5 going this month. I mean, the bread and butter of non-QM and of our programs is going to be bank statements and DSCR. So that's going to be the majority of the scenarios we see just by nature. But as far as like what there's been an uptick in recently, it's definitely fix and flip. It's definitely bridge loan. I've had quite a bit of foreign nationals reaching out recently too. So part of that is because it's a great time to buy for investors, right? They get great deals on sales prices. And a lot of foreign nationals are saying, hey, I want to get involved and buy an investment property. So we've seen a lot of those.
Yeah.
Go ahead, Rose.
I was just going to say that Sergey is saying that he didn't know that this program even existed. So
now he knows. Now he knows.
I don't know if his question is specific to fix and flip or in general, but what type of sourcing and seasoning is needed for a down payment?
No difference. So typically 30 to 60 days.
All right. And can you leverage your contractor's experience if you're a first timer?
Yes. A licensed GC that will show us his last 3 projects will help the investor get a little more loan to cost.
Nice.
Do we need a full bid or just a basic scope of work?
Depends on the complexity of the project. If it's not a big job, we call a simple job rate. I'm getting a phone call from Michael Dunlap, of all people. So let's say we're doing paint, carpet, windows, doors. We're not going to require a lot of detail on that one. Let's say we're doing we closed a loan in Boston, $1 million loan. Lady bought it for 1.3. Her budget on the property is $1,200,000. So that's going to require a scope of work in strict detail from the get-go. So that this occurred, She's 1-3 purchase, 1-2 repair. She's 2-5 in. We have 4 appraisals. Long story. Why? We have 4 appraisals. The ARV is 4.2 million. She's 2-3 in. So that's a win for her. So high-end deals, we're not saying no to those. We don't do any loans over 2 million. So that's a hard limit for us on fix and flip is $2 million.
And
But
4
scope of
units
work is
tops.
limited to, it's based on the complexity of the project.
Okay. Can you do rolling funding for someone who is doing 9 properties in total?
We have a limit of 10 loans. We approved a loan yesterday in Texas, 4 deals rolling. They're all coming in, boom, 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 boom. But we stop at 10.
Okay. And can borrowers contact you directly?
Yes, and they do. Often when the application comes in, it's the first fix and flip for a loan officer, not really understanding the process or the program. They've never done one. We will get on the phone with the investor direct to talk about some of those complex questions like scope of work and what's happening with the property. We'll do that direct.
How do we document experience of the investor / flipper? Do we provide addresses of homes they've already completed?
3 addresses, and then in the underwriting process, they will look for 3 closing statements. So some HUD settlement statements to show that the project closed.
Like DSCR, do we need to be licensed in states where we are doing the fix and flip deal?
This is the most unregulated loan that we've ever made. So no, we don't look for that.
It depends on the state, right? And this goes to DSCR. There are some states where you don't have to be licensed in the state to originate a business purpose loan. There are some states that do require it. With fix and flip also being considered, commercial business purpose loan, it also falls under that umbrella.
Right.
Okay. And you mentioned before, but please repeat about the rates. What are our rates looking like for fix and flips?
Rates range from a low of 10 to a high of 12. Pay attention to the points as well.
Not sure I understand the question, but I'll read it to you. Maybe you do. Do you lend on minimally started projects?
Yeah, I mentioned we call them midterm projects. Somebody bought it, they started the work. For whatever reason, it got stalled. It's been delayed. It's 6 months, it's a year, nothing's happened. We will look at those. In the case where there's no current mortgage on the property, they bought it, they paid cash 2 years ago, a year ago, whatever. If there's no mortgage, we'll look at it. If they have a mortgage, our first phone call is to the mortgage holder, and proving that that thing was paid on time is of paramount importance. So yeah, we'll look at them.
Okay. All right, so let's go on to the next one. Referral sources, finding leads. How do we do that?
If I'm a loan officer today, my elevator pitch out of my mouth starts with realtors, my realtor sources, and the first 2 things out of my mouth, fix and flip and bridge loan. That's what I'm talking to realtors about. Every other salesperson in the world is calling them on bank statement loans and traditional loans. Very few people are calling realtors about fix and flip and bridge loans. So realtors is my #1 source. And then you go down, guys, look at the list. There's all kinds of ways to get around and involved with investors. It's all, I won't read it to you, but I joined an investor club myself, attended one of those meetings a couple of years ago. I'm not sure if Janice was with me or not. I took an AE. When I got to this investor club meeting in San Diego, 220 people in the room, couldn't speak, learned from that. How do we speak and sell our program? You have to sponsor the cocktail hour, which cost us $500. So a chance to talk to 220 people, we spent $500 to go talk to 220 people. They gave us a microphone, we had the floor. So all kinds of ways to get around these folks. Realtors for LOs is easy. And bear in mind, realtors are looking for investors because they're looking for houses to sell. They need something to do in this market.
Yeah.
This is a quick exercise. This is an actual search I did for my Facebook. I just put in fix and flip, and then I clicked on groups. And here you can see what's in San Diego, the number of people that came up.
So
Fix and
many.
flip wholesale contractors, 41,000, 69 people, 2.3 thousand, 15,000, 2.9 thousand, 4.4 thousand. There are a lot of opportunities right there. This is a real quick and simple way to, even if you're just
Yeah.
looking to do some more research about what's hot and fix and flip in your area, and you can join these groups, you can offer advice, you can be a thought leader on it. So this is a
Rose, I want to go to the San Diego home show, and every city has these spring and fall home shows, and
Mhm.
lots of people attend. But when you walk through those trade shows based on, home show, every booth there is a contractor selling whatever they sell, windows, doors, roofs, whatever, siding, whatever they're doing. So you're going to meet a lot of people. I want to go there and put up a booth and I'm going to stand in my little trade show booth next to Tanner and Janice, and the sign is just going to say fix and flip financing. I'm going to get business from two people. The contractors that are there are going to be very interested. And two, the people walking by, oh, I didn't know I could buy a house and borrow money to fix it up and sell it for more money. I didn't know I could do that. So Tanner and Janice are going to tell them how they can do that. I want to go to that show, but since I've got more of these than I can handle, I have had no time to go to any shows. But if I'm a loan officer, I could go do that and then call Jim, call
So
LendSure.
speaking of going to shows and shaking hands and elevator pitches, again, here are just some conversation starters that we put out there for you. I offer fix and flip loans designed for investors with any level of experience, but more experienced flippers will receive better terms and rates. Here's the rest of them. Again, I'm going to send a copy of this slide deck to everybody afterwards, and what everybody is looking for: the flyers, the slide deck, the social media graphic, email templates for borrowers and for realtors, so that you can start talking about and generating this business this week, right away, as soon as we get off the phone. You guys can, well, when you guys get the email from me in about an hour with the link to today's presentation, you can click on it to access all of these wonderful resources that we put together for you. Non-QM talking points in general. Guys, how do you guys start the conversation if you're a broker and you're at an open house and you're talking to realtors, or how do you start the conversation about non-QM?
Right. So these are great ideas, Rose. One of the things you can always just say is like, I help people who don't qualify with a conventional loan, right? So it can be as simple as something like a self-employed for bank statements, like we touched upon last week. Or you can also say, you know what, I specialize in these fix and flips, right? It depends on who your audience is, what's going to catch their attention, right? But you can basically introduce yourself and say, look, I work with a common sense lender, or you can say I fund these type of loans. You can always contact your account executive and have them go over scenarios that they funded, and you can kind of make them your own. If this is where you're getting into at the very beginning, be like, well, I know how to close a loan to help, with alternative financing options. A lot of the times borrowers that you talk to, they might have already had kind of a negative experience because they've been turned down conventionally. So if you kind of talk their ear on, alternatives, it really, it's going to light up the room for them too. So those would be some talking points I would do, is say, you know what, I think I can get you a loan. Tell me more about your situation, and go from there.
That's a really good point, Janice, because as you guys as account executives, a broker doesn't need to be an expert in analyzing, let's say, bank statement income or the ins and outs of like fix and flip and all that minutia, because they have you guys. They
Yeah.
talk to you with the scenario, and you guys do the heavy lifting.
We are a good resource. So I do always encourage, after these calls, is call your account executive, email them, set up a time. They can do webinars, one-on-ones, but there's a lot of resources here at LendSure to help you close more loans.
Okay, I have a question from John. Is a cash out on a primary for ADU being built, is the appraisal amount based on the ARV
That's a
after
good question.
after the ADU is completed?
So Tanner, are you still there, or did Tanner freeze up?
No, he's there.
Here.
Yeah.
I have an answer, but go ahead.
ADUs are kind of interesting. One, we need to make sure they're permitted, right? We can't do anything on unpermitted ADUs. Two, we always want to try to be conservative when possible. Ask, you know, an appraiser not to consider the ADU as part of the value. You know, if we need it, it's possible, but need great compensating factors. It would be my answer. Jim?
My answer on that would be if they're going to build an ADU in the backyard, first question is, are they going to rent it or is it just going to be for grandma to live in? Because if it's going to rent it, it's going to affect some income. Our approach would be there will be a new value given by some appraiser that says the property is now worth X. Our loan to value on that is going to be conservative. It's not going to be, oh, we're going to go 80%. It might have been 80 as an SFR only, but now we got an ADU in the backyard. It's just got built. It's no longer 80%. It's going to be more conservative. That would be my answer. I'm thinking like an underwriter.
So whether you call it like a 75 LTV off the new value using the ADU or an 80% LTV off the value, not including the ADU, we're still trying to be conservative in what we're lending, right?
Okay. Today's opportunities with LendSure. Let's talk about the other programs that we haven't covered today.
Ooh,
Yeah.
oh, there's so many.
I know. We talked about some of these last week. Talked a little bit about cash out, right? And the maximums there said 500K on DSCR. It's actually $1 million for primaries. But again, we will go above and beyond that when we have good comp factors. Talked a little bit about non-warrantable condos in relation to condo tells. There's lots of reasons something could be non-warrantable. You know, high investor concentration, high single entity ownership, the active litigation, the HOA delinquency rate, the HOA reserves. So tons of things that could make something non-warrantable. You know, if you have that, run across that, give us a call. We'll talk about it. The 2 to 4s we do on most of our programs. 5 to 8s is another one I think Janice mentioned on DSCR. It's technically a commercial loan, but I've closed one of those, or actually 2 of those now. Second homes is a great one. LLPAs, right? You can't even get your borrower a rate without introducing some bonkers amount of points. We have the ability to say, hey, look, here's, you know, a non-QM rate, a higher rate, but the only points involved are the points to the broker. And if the LTV is low enough, we can even finance those points, so they aren't due out of pocket at closing.
Yes.
All
And that's a
right.
good point on the LLPAs. That's a good point, Tanner.
Yeah, very good point. And don't forget that there's also our hybrid loans, right? If you have a weird situation where income documentation is a mix of 2 of our programs, we'll take a look at it all day long, right? So anyway, I think we've gone quite over, but there's just so much to touch upon here that I know everybody had a lot of questions, which is amazing. That means you're interested, and it means that I'm sure we'll be hearing from you very soon. I guess, Rose, any other questions we can answer?
Well, I'm gonna ask her. I know that we were way over on time, so I am gonna ask a few questions. But please feel free to reply to the email that you're gonna get in about an hour, and you can contact me directly. I will connect you with your LendSure account executive, or I will get you whatever resources you need. On a bridge loan, is there a prepayment penalty? If they only want to hold the property for 1 to 2 months, is that okay?
So let's make sure we're on the same page, right? Because there are 2 loans on the bridge, right? So the bridge loan itself on the departing residence has no prepay and no EPO. You could sell that home and pay off that loan a day after you close if you wanted to. And I've actually had that happen, funny enough.
Same.
The market was moving fast at that point in time, and so the seller was going to pull it and relist it. And so like they had the bridge loan for like 5 days, I think. It was bonkers. But you know, you can pay that off right away. The purchase loan, however, so no EPO, no prepay on the bridge. The purchase loan, however, will have an EPO. It may have a prepay if it's an investment property, if you're doing investment to investment. If it's owner-occ, there's not a prepay. There's no prepays on any owner-occ loans we do. But you have to make sure you pay attention to the EPO, and the prepay on investments comes standard at 3 years. We can buy it down to 2 years or to 1. But if they were trying to sell that new property they just bought, that subject purchase in 2 months, we would have issues with that because of the EPO.
Correct.
Tanya, thank you so much for the kind words. That means a lot. I'm glad you got some value out of the webinar. Kate wants to know how long do they have to complete the renovation for a fix and flip? How soon do they have to sell the property?
Our note is written for 1 year, so 12 months to get the project done. Sooner the better, because remember, they're paying interest and carrying cost.
All right. So with that, I am going to say thank you so much, everybody, for attending. Please feel free to contact me directly with any additional questions, or of course, reach out to your LendSure account executive. They're there to help you be successful. With that, I'd like to thank everybody for joining us. Tanner, any last words for our audience?
No, appreciate you guys' time. Sorry we went over. Hopefully answering the questions certainly helped. And again, reach out to your account executive. Anytime you have something that you can't get through Fannie Freddie, we're here to help you.
Fantastic. Janice?
Thanks everybody for your time, and honestly, just what Tanner said is if you have any questions, reach out to your account executive. If you don't know who that is or don't have one, reach out to Rose and she'll direct you to somebody in your area who's going to help you. And we really do look forward to helping you close more loans, and have a wonderful rest of your day.
Awesome. Jim?
Remember, we don't have any automated underwriting. We think through loans. We're common sense lenders. LendSure's #1 niche. We can think through a loan the way it should be thought through.
All right. Thank you so much, everyone. Have a great time.
Thank you.